Dividends are often touted as the best way to generate cash flow from your stocks, but sometimes dividends might not always be what they seem. What's up everybody, I am Jaspreet Singh from theminority-mindset.com, where money minds rethink rich. Dividends are when a company takes their profits and they distribute it to people like you, shareholders, in the form of a cash payment. So it's a way for you to make money off of your stocks without having to sell your stocks. I'm a real estate guy, so I love the idea of cash flow because when I invest in real estate, I'm buying real estate to generate cash flow. I buy a property, I rent it out, and now this property is going to pay me with cash flow every single month. And so when I heard about this idea of dividends, that you can invest in companies and then these companies are going to pay you with cash flow, I love the idea. My stock portfolio used to be pretty much just a dividend portfolio because my goal was to generate cash flow. I looked at the stock market just like I did the real estate market, that I wanted to generate as much cash flow as possible, but now I've kind of changed that. I still own some dividend paying stocks, but I moved away from just owning dividend paying stocks because sometimes dividend paying companies don't always give you the best returns. That's why in this video, I want to go over some of the things that are not commonly talked about when we talk about investing in dividends. That way you can make your investment decisions in the smartest way possible. That way you can invest your money in the way that's going to make you the most money possible. So let's jump right into it. But before we do that, I need you to do me a quick favor and smash the thumbs up button below. And if you're looking for some extra Minority Mindset, we have some new Minority Mindset channels that you can check out. We have the Minority Mindset News channel where Nate publishes daily finance and business news videos. We have the Minority Mindset Clips channel where you can watch shorter Minority Mindset videos. These are videos somewhere between 8 to 12 minutes of me talking about financial education. And then we have the Minority Mindset Spanish channel where you can watch our content in Spanish. So if you want to check out these Minority Mindset videos, I'll put the link to where you can check them out and subscribe in the description below. When a company makes money, there are three things they can do with the money that they make. They can reinvest this money back into the company. That way the company can grow bigger. That way they can grow faster. That way they can make more money. They can save the money for emergencies because sometimes things go wrong and they need to have some cash reserves. Or they can give this money to the shareholders in the form of stock buybacks, which means they buy back their own stock, which makes the stock price go up. Or they can give this money to shareholders in the form of dividends, which means that now they're just giving you money in the form of a regular dividend, a cash payment. Every company goes through a life cycle kind of like this, where in the beginning, this is your startup phase. The company is just trying to get off of the ground. They're just trying to figure out, do they have a real opportunity here? Do people like this product? And in this phase, they might not be making much money, but they're trying to just figure out, are people actually interested in the product and service that we have to offer? Then after that, we go into the growth phase. So this is an interesting phase right here. I'm gonna put startup here. So in this growth phase, this is where companies are trying to now expand their market share. They realized here that, hey, we have a real opportunity here. People like our product, but you might have some competitors. And so this is where companies are trying to really figure out, can we be the leading industry company in our industry? Can we be the top player in this industry? And the way they're trying to do that is by taking as much market share as possible. So the biggest example of this is what Uber did. When Uber went into new markets, what they would do is they would charge very low rates for their fares. If you wanted to take an Uber, you would pay very little money. Now you would take a ride to wherever you want to go, not pay that much money, and you would say, wow, this is really cool. I got a really good ride and I didn't have to pay that much money. So you started to like Uber. Now, you might be wondering, how did they pay for their drivers? How did they pay for their services? Well, they were losing money. They had money from investors. They were borrowing money from the bank. And the reason why they were losing money is because Uber was paying the driver. They were paying the extra costs just to get you to use their software and to get you to use their app. Because if they could get you to be a loyal subscriber, then eventually they'll be able to raise their prices so they could one day hopefully be profitable. So that was their big business model. They wanted to go into new markets and undercut the competition. They wanted to undercut the taxi companies. They wanted to undercut other companies. That way people wanted to go to Uber, and the way they subsidized that cost was through other money, right? They were taking this other money they were getting from investments and debt to fund these other costs. That way drivers were getting paid. That way you would get a low fare. And if they could grab all the market share, then eventually they could hit a point where they'd become profitable. Then after this growth phase, if the company continues to survive, this is where you start to hit something like the scaling phase. So in this phase, this is where a company is now trying to figure out how they can grow even bigger outside of just their core product. So you'll see companies now acquiring other companies. You'll see them innovate into new industries. You'll see them do a whole bunch of things to expand what they're doing instead of just having one product. like how now Uber is acquiring other companies. They're doing a lot of different types of innovation. That way the Uber Corporation is not just in the business of driving you from your home to the airport. They have lots of different companies under the Uber brand now. And so they try to scale into these new different industries. That way they can grow from just a company with one product to a whole conglomerate corporation. And then if the company can keep growing, this is where now you enter the mature phase. This is where now the company has a lot of new products, they have a lot of revenue, and now they should be pretty profitable. They're making a lot of profit at the end of the year, and now this is where they have to decide, what do they want to do with this profit? Do they want to keep trying to innovate and grow? Do they want to save a lot of money? Or do they now want to reward their investors who stuck by them and now give this money back to investors either in the form of dividends or stock buybacks? When a company hits this mature phase and now they start paying out dividends, they know that now they're pretty large and they're not going to be able to grow as fast as they did when they were in the growth phase or the scaling phase. So when they're in the mature phase, what they're trying to do is just sustain a steady rate of growth instead of trying to grow very fast like they did here. And so when you're investing into companies in this mature phase that are paying out dividends, what you're doing is you're just trying to buy a steady stream of income instead of trying to see this growth, which isn't necessarily a bad thing, but it depends on what your goal is. Because if you're younger and you're willing to take on more risk, then hey, you don't really have that here. What you're doing is just buying a steady stream of income as opposed to potentially seeing a whole lot more potential upside here. Now, this also comes with risk because there's also a chance that a company is going to go here and here and then realize, oh no, we made a mistake. We didn't do something right. Or people don't like a product. Or something goes wrong, and then the company goes bust. So you have the opportunity now to lose your money because this is more risky here because a lot of times these companies are not profitable. And so if something goes wrong, the economy slows down, something happens to the company, well, then you can see the company go down. But you also have the opportunity to see a whole lot more upside here because you're buying a company in its growth and earlier stages as it's trying to grow and acquire more market share. So that is the advantage here. Although you're not getting the steady cash flow, the goal is to buy a company here and then hopefully ride it up here. That way you can buy it, get that appreciation, and then once they get to this maturity phase, that's when they start paying out dividends, and now you're getting to reap the rewards of your investment because you bought it earlier on. So if you're in your 20s or your 30s or maybe even your 40s, you got to decide how much risk do you want to take. Because if you're younger and you're not thinking about retirement yet and you don't need this other stream of income yet because you have a job or your business or whatever you have to decide, where are you in this risk scale? Are you okay taking more risk and seeing more potential upside because you're younger, you have more time to go through economic crashes and swings and stock market slowdowns and booms and busts? If you're younger and you have time for that, maybe it's okay if you take on more risk. But if you don't have that risk appetite, then this is where you want to be. So that, you got to start asking these questions to yourself and understand, where do you want to be? Because what's right for me might not be right for you. What I started to realize is I was investing a lot here, but I do have a bigger risk appetite. So I still have some of my investments here, but now I started investing in companies here, here, and even here. I also invest in companies that are not on the stock market. That way I can help these entrepreneurs grow and scale. And so I like investing in companies in different stages, but you have to understand what's right for you. The second thing that I want you to be aware of with dividends are taxes. Because now anytime you get paid, you got to pay your taxes. And so if a company is paying you a dividend, now you have a taxable income. Because if a company is paying you with cash flow, you got to pay taxes on the income that you get. And the thing that you have to pay attention to this is, even if you take the dividends that you get and you reinvest it back into the company, you still have to pay taxes on the income, even though you don't actually get to keep that income. So let's assume that I invest in a company like McDonald's. They pay me $10,000 in dividends, and I take all this $10,000 and I reinvest it back into the McDonald's corporation. So I don't have this $10,000 in my bank account, but I'm going to have to still pay taxes on this $10,000 worth of dividends, even though it was automatically reinvested. This $10,000 didn't come into my personal bank account. It was automatically reinvested back into the McDonald's company, but I still got to pay taxes on this $10,000. That means that you're going to have to budget for these taxes through your other income. So if you're making money from your job, you're going to have to budget some extra cash from your job to cover your taxes on your dividend income, because you're not actually getting that income today. The whole reason why you're reinvesting your dividends is that way you can own more shares of the company. That way you can get bigger dividends. And if you're reinvesting that, well, that means you're also going to have to pay more taxes. So that's something that you have to keep in mind. If you're investing in dividends, that you're going to have to pay taxes. And one of the things that's very interesting about dividends is that a lot of times what you'll see happen is that when a company issues a dividend, you're going to see their stock price fall by the amount of the dividend. So this is a lot more apparent if you're investing in things like REITs. REITs are real estate investment trusts, and real estate investment trusts are known for giving up big dividends because REITs are required to follow the 90% rule, which says that these real estate investment companies, these real estate investment trusts, have to pay out 90% of their taxable income, their profits, to people like you, shareholders. And so REITs typically have higher dividends. And when I first really started getting involved in the stock market, I wanted to look at the stock market like real estate. So I really started investing in REITs because some of these REITs were paying double-digit dividends. Some of them were paying 10, 12, 15, even 18% dividend yields. So I was like, holy moly, I can make a ton of returns in the stock market by investing in REITs. But what the dividend doesn't tell you is the potential risk you also take with some of these high dividend paying REITs. Because if a stock price is falling and the dividend hasn't been adjusted, well, now your dividend is going to look artificially high because this company is on the decline. But I'll get to that in just a little bit. So I was investing in these REITs, paying out these high dividends. And what I would see happen is I would get this big dividend payday, but then anytime the dividend went out, you would see the stock price tank by the amount of the dividend. So if you look at any dividend paying company, what you're going to see listed is that they have something called an ex-dividend date. So if we look at McDonald's here, you can see that they have a ex-dividend date. What the ex-dividend date says is that you need to be the owner of the stock before the ex-dividend date if you want to qualify for the dividend. So if you buy the stock on the ex-dividend date, you will not qualify for the stock's dividend, but if you buy the stock before the ex-dividend date, then you will qualify for the dividend. Now, if you want to play it safe, then you want to own the stock a couple days before the ex-dividend date, but you really just need it before the ex-dividend date. Then what happens is on the ex-dividend date, the price of the stock will fall by the amount of the dividend. So if the stock is trading for $100 a share and they're giving a $1 dividend, then you're going to see the stock price fall to $99. Now, this doesn't mean that it's going to only trade at $99 that day, because if the stock has a lot of interest behind it, you can see the stock price pop right back up, or you can see it go down more. There's a lot more things that will happen in the day, which means that it's not just going to stay at $99. So you can see it go back up or down, but you're going to see this initial fall because it's a way to prevent people from just buying stocks on the day that they pay out dividends and then selling it right after that. That way you can just get this free fall of this cash flow and then just sell the stock right after you get it. And then you have to value in the fact that you're probably going to see slower growth in the company because they're paying out dividends, because now they're paying out their profits. They're paying out their cash, which means this company is going to have less money in their actual accounts to reinvest to grow the company itself. Because if a company has, let's just say, $1 billion of free cash flow, of extra cash, and if they give all this $1 billion out, well, now they don't have that $1 billion to reinvest back into the company. If they had the $1 billion, maybe they would open new stores, or they would innovate more, or they'd hire more people, or do something to grow the revenues, to grow the profits even more, but they're not doing that. They're just giving that money out to shareholders, and they're saying, you have better use for the money than we do. And so they're just giving that money away, which means the company is going to be growing slower naturally. The reason why they're doing that, again, pull this back right here, is because they're here. They've hit this mature phase where maybe they don't know where to actually invest all this extra cash, or they don't know what to do with this extra cash. And so what they want to do is not keep trying to grow like this because this is too risky for them now. And instead, they just want to see slow and steady growth. Now, what you don't want to do is invest into these dividend paying companies, which are on a trajectory like this, down. What you want to do is invest in a company that's still growing, although it might not be as fast as it would be here. You still want to see the company growing because you still want them reinvesting back into the company. That way they can continue growing. That way not only do you continue to see growing dividends, but you also see a growing stock price, because a company's dividend isn't going to stay flat. What you want to see is you want to still see this company reinvesting back into themselves. You want to see growing revenues. You want to see growing profits. And if they do that, that means they're also going to want to increase their dividends because now the stock price is going up, because dividends are paid out in dollars, not in percentages. A lot of times when we talk about dividends, we talk about them in percentages. Oh, this company's paying out a 3% dividend, or a 4% dividend, or a 5% dividend. But what that actually means is they're paying out a dollar amount in dividends. Because when a company comes out and says that we're going to issue a dividend, what they say is, hey, we're going to issue a 3% dividend next quarter. And then people go look at it and they say, oh, that's going to be a 5% dividend. But what you need to understand is that this company is going to issue dividends in dollars, And so if they start to see the stock price go up because they're making bigger profits, you want to also see them say that we're going to increase the dividend amount. That way you're getting more dividends because now your stock is more valuable. But the only way that a company is going to be able to pay out bigger dividends is if they have bigger profits, which is why you want to make sure that you're analyzing your companies and you understand what your company is doing with their money, because if they don't have bigger profits, they're not going to be able to pay out bigger dividends. That means you need to be studying a company's cash flow statements and their profit and loss statements. It needs to understand the earnings of a company. That way you can see what they're doing now and what they plan on doing in the future. That way you can invest in a company that is still growing for the future instead of just investing in a company that is satisfied and not doing anything and just paying out their profits, because that could mean that the company's on the verge of going down. We're going to jump back into the video in just a second. But before we do, I want to talk to you about our Market Insiders program, because if you're interested in investing your money in the stock market and the real estate market, our Market Insiders program can really help you with that. Market Insiders is not a class. It is a weekly group coaching session. Every week, you're going to get access to a live class where you'll learn something about how to invest your money in the stock market and the real estate market. And because these classes are live, you will be able to apply what you learned to the real world. So for example, let's assume that this week's coaching session is on the topic of how to read a cash flow statement. That means for the first half of the class, you might go over what is a cash flow statement, how to find a cash flow statement, what it means, and how to understand it. And for the second half of class, if Amazon released the earnings statement this week, you might actually go over Amazon's cash flow statement. That way you can apply what you learned, since all of these coaching sessions are live. The real estate coaching sessions work the exact same way. You're going to go over a lesson like how to understand the cash flows of a property or how to find an undervalued property, and then you're going to apply what you learned to today's market. As soon as you enroll in Market Insiders, not only are you going to get access to our stock market and our real estate coaching sessions, but you're also going to get access to our stock market beginners class for free that will walk you through everything you need to know to get started investing your money in the stock market. And you're also going to get access to all the previous coaching recordings, that way you can go back and learn more, and you're going to get access to our private community of serious investors. This is our exclusive Discord community that's made just for Market Insiders, and you can go into this community, network with other investors, and you can ask your questions. When I was working to create Market Insiders, there were two things that were very important to me. First, the coaches, because I wanted to make sure that the teachers were real investors, and second, the pricing, because I wanted to make sure that it was very affordable. First, talking about the teachers, all of our coaches have been vetted. These are not some random gurus that we found. These are real investors, people who have been investing their money for years, people who've gotten great returns, and people who have the money behind them. We're talking about hundreds of thousands, if not millions of dollars invested themselves. So these are real investors who are doing what they teach. And on the price side, it was very important to me that Market Insiders was an affordable program. I didn't want to create a program that would cost you $1,000 or $900 to get started with Market Insiders. I mean, it costs less than the price of dinner for two if you want to get started with Market Insiders. And you don't even got to take my word for it, because I know there's a lot of crappy products on the internet. You can try out Market Insiders for free. We have a free 10-day trial where you can go through the entire Market Insiders program, and then you can decide if it's right for you or not. During this free trial, you're going to get access to everything. You're going to get access to our group coaching sessions. You're going to get access to our free stock market class. You're going to get access to our previous recordings, and you're going to get access to our private community of investors. This way, you can try it out and then decide if it's worth the money or not. If you start Market Insiders, you try it, and then you realize that you hate it, well, then you can cancel your membership during your free trial, and it won't even cost you a penny. But if you start Market Insiders, you try it, and then you love it, well, then you can decide if it's worth it or not for you. This way, you literally have nothing to lose. So if you want to learn more and get started with your free 10-day trial to Market Insiders, I'll put the link to where you can get started and join with the free trial in the description below. You also got to be aware of what's going on in the broader economy, because we are entering a strange decade. The decade of 2020 to 2030 is going to be very different than the decade of 2010 to 2020, because 2010 to 2020 was a big growth decade. We were coming out of this massive recession and the economy was on the upswing. In 2020 to 2030, we are coming out of a pandemic, again, another recession, but the economy is not the same as it was in 2010, because after 2010, we saw a refresh. We saw the entire market go down, we saw the economy go down, we saw everything slow down, and then we started to see the country rebuild. After 2020, we never really saw that refresh. And so now a lot of economists are saying that we're going to pay the price for that through inflation and through slower economic growth. Back in the day, it wasn't uncommon to see the United States economy, the GDP, grow by 4, 5, 6, even 8, 9% a year. And so our economy was able to grow fast because we were smaller and we had a lot more innovation happening. So when you invested in these types of value companies and you grew just as fast as the economy, you were still getting great returns. Now our economy, our GDP is so much bigger. So it's not as easy for us to see these massive returns every single year. It's not as easy for our economy to grow by 8 or 9% a year. We're just trying to see 2% growth a year. And because of that, these larger companies might not be able to grow as big because our economy is not growing as fast as they were. Now again, we don't know for sure. This is just what people are predicting. But these are the type of things you want to pay attention to. You want to understand the company and the individual kind of risk tolerance that you have. And then you want to understand the economic issues and what type of growth do you want to see. Because if our economy is not growing very fast and you're investing into a larger value company which would grow as fast as the economy, well, if the economy is not growing, then your company might not be able to grow as fast. So you just got to understand what your goals are and make sure that the way you're investing is aligning with your goals. The way you win as a dividend investor is by consistently investing your money into the dividend paying company. That way you can start generating the cash flow. You reinvest the cash flow. That way now you keep buying more shares of this company that's paying you with cash flow. That way you can kind of build this snowball that's compounding and building and just producing more and more cash flow. But you also have to factor in taxes and you also have to factor in your growth. And this can be fine if that's what your goal is, but you have to understand what your goal is. Because if you're trying to see the biggest growth possible, if you're willing to take on more risk because you're younger, you have more time, and you want to see more potential upside, then maybe that's not what you want to be doing. Maybe it is. Just depends on what your goal is. This is why I always say the most important thing when it comes to investing your money in the stock market is not what company you're investing in, it's what your strategy is. Because what's a good investment for you might be a bad investment for me. And what might be a good investment for me might be a bad investment for you. So you have to make your decisions based off of what your goals are and then create a strategy that will help you get to your goals, because you have to be financially educated when you make your investment decisions. If you like what you saw so far, then you're gonna love this. Crowdfunded real estate is when you and a bunch of other people invest your money into a fund that gives you exposure to a handful of real estate properties. You cannot invest in crowdfunded real estate on the stock market. You have to typically use a crowdfunding service, and once you invest your money into a crowdfunded real estate fund, you're not gonna get your money back typically for years. A REIT is a real estate investment trust, and this is where you are investing into a company that's investing into real estate investment properties. Unlike crowdfunded investments, you can invest in REITs on the stock market, so you can buy and sell REITs whenever you want. If you're subscribed to this channel, you know that I love investing in real estate. If you're not subscribed to a channel, you should probably do that, but I invest in rental properties. I have invested in crowdfunded real estate and REITs, and all of these real estate investment options have their own pros and cons. This video is all about investing in REITs. Now, while I'm not going to go over crowdfunded deals in this video, if you do want to learn more about crowdfunded real estate, I have an article on our website where our team goes over everything you need to know about investing in crowdfunded real estate deals. And if you want to read this article, you can do it on our blog by clicking the link up here, and I'll also link it for you in the description below. The reason that people love real estate as an investment is because you can create, for the most part, predictable passive income. You buy a property, and to keep things simple, let's say you buy a house for $100,000, and then somebody moves into this house, a tenant, and this tenant is now going to pay you $1,000 a month every month for living in your house. But buying and operating your own rental properties is a little bit more extensive because, one, you need to have access to the cash to buy the property, and two, you need to have the team built. So that means you need to have access to the real estate agents and the contractors and the attorneys and the accountants and the property managers, so it's more involved. This is where REITs come in handy, because you can invest in a REIT, which is a company that is now going out and investing in real estate and making money through rent. The cool thing about REITs is that they are required by law to pay out 90% of their taxable income or their rent to you, shareholders, through dividends. REITs make money by buying real estate properties and then leasing them out to other people. That way they make rent. So now they take all this rental money that they get and they pay their bills, and now they take 90% of whatever money is left and they have to pay this money out to you and other shareholders through dividends. A dividend is a cash payment that a company gives you. So now, instead of you going out and getting rent from a tenant, you are investing in a company that's going to manage the property and do all the work, and this company is going to pay you a share of their profits through dividends. REITs are a popular way for you to invest your money if your goal is passive income, because REIT stocks tend to pay pay much higher dividends than regular stocks. Some REITs pay 10% dividends. That means if you invested $100, you will get $10 back this year just through dividends. But before you just jump in and invest in a REIT just because they're paying a high dividend, there are 3 things that you need to know. You need to know how dividends work, you need to know what kind of REIT it is, and you need to know what this REIT invests in. When you invest in a high dividend paying REIT, what you'll typically see happen is that when a dividend is paid out, this is called the ex-dividend date. So when the dividend is paid out, you will typically see the stock price of the REIT fall by the amount of the dividend. So if a stock is trading for $200 a share and it pays out a $20 dividend, you will many times see the stock fall to $180 a share the day that the dividend is paid out. If it's a really strong REIT, you'll see the stock price climb back up because investors will use this dip as a buying opportunity to buy the stock. And when it comes to dividends, we have to talk about taxes. Dividends that you get from REITs are typically taxed differently than the dividends you get from regular stocks. Typically, if you go out and you buy a stock and this stock pays you a dividend, you get to pay a very low tax rate on this dividend called the long-term capital gains rate. This long-term capital gains rate is usually a lot lower than the tax rate you pay on the money you make from your job, which is called ordinary income. Well, the IRS says that you have to pay taxes a little bit differently when it comes to REITs. The government said, okay, because REITs pay out higher dividends, it's almost like another income stream for you, so we're not going to give you the long-term capital gains rate, which is a special lower tax rate. You have to pay the ordinary tax rate, which is the higher tax rate on REIT dividends. If you have an accountant or a tax software filing your taxes for you, this isn't really something that you have to worry about too much when you're filing your taxes because this should automatically be calculated. This is more something I just want you to be aware of so you understand how the tax game works. Now, I also do have to tell you that while I am an attorney, I'm not your attorney, so if you have specific tax questions, make sure you talk to a tax professional in your area. Now, let's move along and talk about the different kinds of REITs because you have 2 different kinds of REITs. On one hand, you have equity REITs. These are REITs that go out and they operate and they own real estate investments and they have tenants that pay them rent. Then there are mortgage REITs which invest in loans and mortgages. These mortgage REITs make money when landowners and property owners pay interest on their debt. Both type of REITs come with their own fair share of risk. I mean, the mortgage market is going to go through their own cycles, just like how the real estate market is going to go through their own cycles. And some mortgage REITs are going to invest into more risky loans, and some equity REITs are going to invest in more risky properties. You got to know what kind of investment you want. Being a mortgage REIT or an equity REIT doesn't necessarily change much when it comes to researching a REIT. It changes more of how the company operates. Like AG&C, which I talked about earlier, was a mortgage REIT, and SPG, which I also talked about, is an equity REIT. Again, I'm just giving you these REITs as examples. I'm not telling you what to invest in, but once you understand what the different kinds of REITs are, that's when you can look at what these REITs actually invest in. Some equity REITs, so these are the REITs that own and operate their own real estate, will invest in residential real estate, so apartments and homes. Other REITs will invest in hospitals. Other REITs will invest in office space. Other REITs will invest in malls. Ask yourself, if you had an unlimited amount of cash, what kind of properties would you want to own? You do not, I repeat, you do not want to buy into a REIT just because they're paying out a high dividend. A really high dividend yield could mean that a company is making a ton of profit and the stock price hasn't caught up to it yet, which is good. And it could also mean that the stock price is tanking because the company is having a problem and the dividend hasn't adjusted yet. That is bad. With mortgage REITs, you gotta look at the same thing. Some mortgage REITs will invest in mortgage-backed securities, some will invest in commercial loans, some will invest in commercial mortgage-backed securities, and others will invest in high-risk mortgages. The mistake that a lot of people make when they invest in REITs, and this happens for any stock for that matter, but especially in REITs, is that they think that they're investing in a ticker symbol as opposed to a company. They think, wow, this stock is paying out a 10% annual dividend. Let me just throw all my money into the stock because I'm gonna make 10% of it back every single year. But if you're getting a 10% annual dividend while the stock price is falling 20% a year, you are in a losing situation. But if you know what you're doing, you have the opportunity to win twice because now you're gonna invest into a strong company, which means your dividends are going to go up because they're making good acquisitions, and the stock price is going up because the company is becoming more valuable, so now you're winning twice. Now, if you've made it this far in this video and you're thinking to yourself, man, I would really like to invest in REITs, but I don't trust myself to do the research, or I don't know how to do the research, or I just don't want to spend the time doing this research, then you may want to consider investing into a REIT ETF. An ETF is a fund that invests in a whole bunch of different stocks. So now, instead of you going out and trying to find the best REIT to invest in, you can invest in a REIT ETF, which is an ETF which invests in a whole bunch of different REITs. This would be like investing in VNQ. Again, I'm not telling you what to buy, just giving you an example. VNQ is an ETF that invests in REITs. So now if you bought shares of VNQ, you will have exposure to 180 different REITs because VNQ is a fund that invests in more than 180 different REITs. So REITs are a way for you to get exposure to the real estate market without having to actually manage and operate your own real estate investment properties. And unlike crowdfunding, REITs allow you to access your money whenever you want.
We've given up trusting the banks. We've given up trusting who were supposed to be the fiduciaries, and we can take control back ourselves. Even identity will go on the blockchain, so we can share it with Facebook and Google on the terms that we accept. So this is a technological and a financial and a cultural revolution all at the same time.